Bankruptcies are hitting average American families and U.S. businesses really hard in 2024, according to data from the U.S. courts. Higher consumer prices are making Americans take on massive loads of debt just to get by, while businesses are being impacted by decreased sales and falling profits at a time costs continue to climb. The credit crisis is now reaching levels last seen during the Great Recession, with big banks tightening their lending standards to prevent further losses and more failures in the months ahead. In fact, the Board of Governors of the Federal Reserve System reported that bank credit levels have fallen for 3 quarters in a row, marking the first sustained contraction since 2010. This is only the second such decline in more than half a century. The last one was witnessed during the years of 2008-2009, when the world was grappling with the repercussions of the global financial crisis. The extended slump in bank lending comes as many Wall Street analysts continue to project a pessimistic outlook for the U.S. economy. Bank credit is contracting for only the second time in 50 years, stressed Thilo Maratz, head of liquid assets at German insurer Continentale Versicherungsverbund. The credit contraction means that companies and consumers will have to borrow less, with higher interest rates making it more expensive to take out loans, he explained. When it's harder to raise debt, businesses are less likely to go on with spending projects, and consumers are forced to delay big purchases, including cars and homes, which can further drag on economic growth. Record high interest rates only add insult to injury. Still, the central bank has signaled that it will not start loosening monetary policy until it reaches its 2% target. Until then, it'll be tougher for households and businesses to access credit, experts say. Late last month, the Federal Reserve Senior Loan Officer Opinion Survey revealed that most banks in the U.S. tightened their lending standards during the past quarter. For businesses, 51% of banks tightened their lending standards for commercial and industrial loans to large and middle market firms, while 68% tightened standards for commercial real estate loans. Since February, commercial real estate loans held by banks have declined by $33 billion due to rising delinquency rates and high exposure to the sector's ongoing crisis. 5 financial institutions that held billions in commercial real estate loans have collapsed over the past year, including Republic First Bank, which was seized by regulators and sold to a rival last month. In terms of loans to the household sector, credit tightening continued to squeeze residential mortgages, but soaring mortgage rates helped to keep demand for loans down during the first 3 months of 2024. On the other hand, demand for consumer loans, which includes credit card, auto, and personal loans, continued to rise, despite banks' decreased appetite for lending. The Fed survey also showed that 36% of U.S. banks tightened their standards for credit cards to consumers, an increase from 30% at the end of 2023. The latest numbers have fallen into an area consistent with past recessions in the U.S. For example, the share of banks tightening standards for commercial and industrial loans to U.S. businesses was 32% in the first quarter of 2008, and before that, 51% in the first quarter of 2001. Some bankers have pointed their fingers at falling deposits as the culprit. How can we make loans when we don't have deposits, they ask. And they do have a point. Over the past 12 months, total bank deposits have dropped by a whopping $313 billion. However, U.S. financial institutions are feeling much more pain than this figure suggests. Core deposits, total deposits minus large certificates of deposit, are down $1.1 trillion over the past year, and reality is even worse than this. Both checking account balances and money market deposit accounts have fallen too. Another major concern, adding pressure on bank officials who set credit standards, is the duration of the economic recession. A poll conducted by the Wall Street Journal found that 63% of economists and financial analysts expect the economic slump to extend for at least another year. No wonder why bankers are fearing more institutions could collapse in the second half of 2024. Further aggravating the scenario, both personal and commercial bankruptcies are causing steep losses for big U.S. banks this year. Data from the U.S. courts exposes that in April, business bankruptcies jumped by 40% compared to the same time a year prior. Meanwhile, personal bankruptcies rose by 16%, with more than 434,000 filings reported year over year. According to experts, the impressive number is a sign of the times. Michael Schwartz, a bankruptcy attorney in Philadelphia, said that higher interest rates, minimum payments for credit cards, and the end of the student loan payment deferral created big financial challenges for Americans. These factors have caused expenses for families to rise significantly, and many are resorting to bankruptcy for relief, Schwartz told Newsweek. Total credit card debt in the U.S. has reached a record high, surpassing $1.13 trillion, and making it clear that this isn't just a financial one, it's a personal one too. The disturbing statistics in our credit card debt crisis say a lot about our society's relationship with personal finance. Every dollar adds a strand to a tightly knotted web of borrowed stress, where the average American household carries nearly $7,932 in credit card debt. To make things worse, about 25% of indebted Americans are allocating less money toward chipping away at their balances every month. Debt holders say they put around $363 per month toward their credit card debt this year, and that's slightly less than the $430 they paid monthly in 2023. One reason people are contributing less is due to record high credit card interest rates combined with elevated prices for everyday goods, highlights Matt Schultz, chief credit analyst at LendingTree. It tells you that people are really struggling in the wake of stubborn inflation and other financial headwinds that they've faced for several years, he added. People have less money to contribute to their financial goals, like paying down debt. But putting less money toward paying down your credit card debt in the short term could have major consequences in the long term. That's because if you're not paying off your bill in full, interest charges continue to accrue and pile onto your unpaid balance, making your debt load even higher and hurting your credit score. More importantly, putting extra money toward interest charges means that money is not being used to build up your emergency savings or your retirement fund, Schultz stresses. Today, the average interest rate on credit cards stands at a jaw-dropping 21%. For the millions who find themselves unable to pay off their balances each month, the debt accumulation can turn into a spiral. With the cost of everyday necessities hitting astronomical highs, young adults and middle-aged Americans are struggling the most. They've had less time and money to put into their retirement and savings, and now they're seeing the current economic environment eating into their budgets. That's the case with Dan Brewerton, a 54-year-old IT worker in New York who found himself filing for bankruptcy after a divorce took a toll on his finances. During an interview with Newsweek, Brewerton warned others about the many downfalls associated with bankruptcy, which often first appears as a relief. At first it feels like an escape, but I've found it can also be a trap. He said you're not allowed to work more than your 40-hour week. Any income above and beyond that is garnished and sent to the bankruptcy trustee for disbursement. Though Brewerton believes Chapter 13 bankruptcy should allow for individuals to work part-time to supplement their income, that is not a possibility today. Consider your earnings are, say, $4,000 a month take-home. You not only pay the trustee north of a third per month, but I also have to pay another $1,000 in alimony. So between those two figures, you're left with a very small amount of money to work with, he continued. Everything else over goes to food, gas, and bills, leaving with virtually no money after paying for basic staples. The IT worker found himself filing for bankruptcy because of his ex-wife's lifestyle expectations. You end up borrowing money from high-interest loan services to support the lifestyle, Brewerton revealed. In the end, you wind up with a huge amount of debt that you cannot pay. This person I was married to simply refused to work, but expected to have the finest things in life. Despite Brewerton's particularities, the spike in personal bankruptcies across the United States shows that his experience is not unique. A combination of factors helped to fuel the rise in bankruptcies, and Brewerton thinks they started with stimulus payments. The stimulus packages were not a handout, he emphasized. They were a high-interest loan that we are paying back by high interest rates. Inflation and growing student loan and credit card debt play a role, but this reality has been in the making for decades now, Brewerton said. Economist and attorney Scott L. Smith argues that the surge in banks' problems is reflective of a lagging economic situation. The increased bankruptcy filings we see now are fallouts from earlier periods of high inflation and economic turmoil, Smith outlines. People were struggling to respond as their air supply was being slowly choked off. Eventually, their options ran out. At the moment, more than 60% of Americans say they are living paycheck to paycheck, according to a Lending Club report. This means most workers in the U.S. are one job loss away from being on dire financial straits. Although we're being told that inflation is improving and our economy is getting back on track, it definitely doesn't feel like that. Our current economy is not as great as the government would like us to believe. Patrick de Césaire, the founder of the financial education company Basic Financial Literacy, told Newsweek. While the stock market bubble is still growing, the fact that so many can't make ends meet is much more telling, he added. For many people out there, stagnant wages, higher living costs, and unexpected expenses create a perfect storm for rising personal debt. But this situation means more than an individual financial strain. It represents millions of people having to postpone major life decisions, entire families in financial lockdown, and a collective sense of insecurity that has become all too common in the American narrative. At the end of the day, the credit crisis and the spike in bankruptcies expose the fragility of our economy and how difficult it has become for average Americans to afford to live in their own nation. How are you affected by this? Would love to read your comments under this video. Please subscribe, and thank you very much for watching.